Welcome, everybody, to another episode of the Tech Guys Who Invest podcast, where you learn how to invest wisely and safely. Today, we have our guest, Martin Saenz, to talk all about note investing. Welcome, Martin.
Thank you for having me, Kevin and Adam. Appreciate being here.
Yeah, we're excited to have you on the show. Thanks so much for coming on. We'd like to educate our listeners today on the topic of notes, which you're an expert on. And I'd just like to kind of maybe kick it off by asking you if you can give us a little bit of an insider's perspective on what the status of the secondary note market is like nowadays, especially with all we have going on. No shortage of interesting environments that we're operating in.
Sure. No, it's a great question. I do get it often, and where things are at in the secondary market from the perspective of mortgage notes is there's a lot of deal flow that has moved upstream for a number of reasons. So there is a squeeze with the mom and pop note investors with note investing at the retail levels. As more deal flow, more activity moves upstream, and that's for a few reasons. One, if you want to kind of go into it, one being regulation, licensing, other kinds of risk factors that banks and larger hedge funds are trying to mitigate by selling to operations that have in-house capabilities to do all the note workouts and asset management type services. And so that's what we're seeing more and more of. So the mom and pop note investors that, we're able to come in and buy notes, low hanging fruit, onesie twosie notes, that's becoming harder for those individuals to do that.
Okay, great. And then for those who may not know the note space really well and some of the technicalities of it, when you're talking about upstream, what does that mean for just the common person?
Sure. So whereas you might come into the note space and you might look to get your feet wet and buy a few notes, maybe spend $10,000, $20,000. Well, a few years back, you'd be able to find plenty of inventory that whereby you can do that. You can accomplish your goals to pick up a few notes, training notes, learn as you go kind of thing. Now in today's market, there is more competition for those few notes, and more of the activity is being withheld by larger hedge funds. So how it's typically works is the banks. We're talking about non-performing notes. So just to clarify for folks out there listening. So
Great.
These are mortgages whereby the borrower has not made a payment in 4 or 5 years. Let's say, for example. So banks hold on to this paper for several reasons, and at some point, after maybe doing some internal charge-offs or what have you, they will go ahead and create a tranche of this non-performing debt and sell it off into the secondary market. And how it's gone years past is they may sell, for example, $100 million tranche out to a hedge fund. That hedge fund A, will go ahead and flip that paper and sell that whole tranche to hedge fund B for $200 million. And so this is kind of like that thing you hear about Wall Street, right? Where they're just kind of shuffling paper and everyone's making money. Well, now in today's environment, because there is more regulation around note investing, hedge funds are what they're doing is they are looking at it as a way to say, well, maybe let's not flip the paper because there might be a liability that's created as a result, and let's create in-house capabilities whereby we can work with those borrowers that are in default and get them into performance plans, loan modifications, reinstatement, payoffs, and other types of resolution, and essentially squeeze more juice from the lemon while mitigating risk by not having to sell that mortgage note off. So it's kind of they're winning at both ends with that.
Wow.
Okay. So just to make sure to kind of summarize what you're saying, the banks are selling to these hedge funds. The hedge funds are then arbitraging it to other hedge funds. And then that waterfall effect eventually comes down to the mom and pop type investors like myself. And you're saying that's getting harder to do because there's a shift now where people are like you said, you're basically trying to figure out, they've found a way to get paid more than once instead of just selling it, maybe working it out and holding on to it. Is that a correct summation
Yeah.
of what you were saying?
Absolutely. So hedge funds that maybe a few years ago were just flipping the paper and not even recording assignments. They were because they were moving products so fast. They may now have a full-blown loan modification team that takes that paper and makes outreach, calls to the bar, has it serviced with full loss mitigation, and they're in full resolution workout mode with those notes. And on the back end, they may have It's kind of
Oh,
like a gloomy. I'm like Dr. Gloomy or what?
yeah,
but
we'll cut this out, but Kevin just lost internet for a sec.
oh,
Yeah,
okay.
it's like,
I was
okay,
like,
it's weird because we'll cut this
I
out,
didn't know what
but
happened either.
I can see it's the audio will cut out, but I can see you talking, and I'm hoping that I can time it right so that I can come back in. I'm trying to read lips and stuff like that, but it didn't work out that way. All right,
you
so
got the tech
we'll go
guys,
ahead
right?
and
We'll
we'll
chop that
take a
out.
footnote there. Yeah. Okay, Martin. So, okay, thank you for helping us understand that. So, just to kind of split off of that and piggyback off of that, what is someone to do if they want to get their feet wet as a note investor if it's becoming harder to do that?
Well, someone that's coming into the space today, they need to be fully committed. So the one toe in the water, one toe out is just not going to cut it. You will you're setting yourself up to get burnt at some point. So you need to be all in, committed, and really you need to look at it as a business venture whereby you're setting up a full-blown business operation by which you're going to grow a note business for yourself. So I think that we're kind of entering the time period where the term note investor is dead. I think it's being replaced with note business. Those days now that's not to say like private money lending or you buy some seller finance loans in your neighborhood, that's fine. But I'm talking about growing a scalable business whereby you're out, putting out millions of dollars to buy mortgages and you're growing a whole operation. That's what I'm talking about. You need to go into it with the mindset that hey, I'm gonna have to commit time and resources to grow a business for myself. And if you don't have the money, that's fine, because if you read my book Note Investing Fundamentals, I go into the notion that deal flow is king in the note industry, not cash or cash flow. So if you set yourself up from a business standpoint with the emphasis on sourcing and generating deal flow at the forefront of your business mission, then you'll be fine in the space.
Okay, that's interesting. And I kind of did want to talk to you a little bit about how a note investor would scale, and it feels like you're getting on the edge of that right now. So maybe we can just kind of dive into it for a sec. And how do you see that happening for this kind of new way of approaching it that you're talking about? How would someone kind of start off and then eventually scale up?
So it's interesting when we use the term scale. You need immediately, a lot of people's minds go to one note to 10 notes, 10 notes to 50, 50 to 100. But that's actually the wrong way to think about it, because you could have one note that holds more value than 100 notes combined. And the way to think about it is in terms of strategic partnerships and who you're aligning yourself with. Who are you servicing? So if one is to really be serious and commit themselves to having a note business, they should be thinking about a number of people that they can bring service to. That should be the thought. So if you, I can tell you that if you could bring significant value and be of service to 100 people within the note space, you will have a thriving note business. But most people don't think of it that way. They think of it like, I gotta get 10 notes. I gotta get 50 notes. And they kind of look at it from that perspective.
That is an interesting way to look. I never would have thought about it from that perspective. So thank you for kind of opening my eyes. And I think that's how I'm going to kind of shift my mentality, because you're right. If you can add value to somebody, they're going to remember that. And they say that the note investing space is really a small world. And before we hit record, we were just talking about people that I haven't even met in person that and then we're chatting about that we all have existing relationships with them. It's crazy how small of a world the note investing space really is.
Absolutely. And there's almost several circles that operate, right? There's the inner circle where they're actually doing deals with each other. And then there's kind of everyone else that's kind of like orbiting around those individuals. So the key is to deliver enough value. But even before you deliver value, this is the part that most people miss, and that is forming the identity. And this is where, I've written 3 books on the note industry. And I just wrote Cash Flow Dojo that just deals with multiple streams of income. So I not only run an operation. I mean, we purchased $23 million of notes in this year. So we're actively purchasing notes. So I not only run that business, but I am, always trying to self-reflect. I'm always trying to understand how I can do it better and dissecting, what's being done. And what I can tell you is this is the part that most people miss. And that is they don't form an identity. So I know that what happens is you don't form your identity, then you kind of fall susceptible to everyone else's, how they navigate you around. And so this is where, but the more you know yourself and know what your buy box is, your buying parameters, that, know that, how much capital you have, what's your resources look like, what's your bandwidth for performing due diligence and doing takedowns, what's your bandwidth on the back end from an asset management perspective, just knowing thyself, as Socrates says, that then the further you will go. And the more people will just gravitate to you and respect you as a person within the space, I should say.
Absolutely. And that's definitely something that Adam and I preach. We talk about investor identity a lot. And when you get into the note space, you realize you can do a ton of different things where you can specialize in certain partials. You can do seconds. You can do, land notes. There's just so many things that you can do within the note investing space. So I love that, because when you figure out your identity, you can figure out how to add value to somebody. And I think that is something to be said. And it sounds like being a mom and pop. Oh,
I'm
sorry,
going to
go
say
ahead, Martin.
something further, Kevin. So service doesn't stop from a sourcing standpoint. So we do, our company does on every transaction, on every trade, we bring in strategic partners to help with certain facets of the trade from due diligence standpoint and other areas. So we're of service to our strategic partners. And when we buy that loan, our mission is to keep the homeowners in their homes with payments they can afford while making a profit for our company. So we're service focused all the way through to the end, whereby we view the borrower as a customer and one that we want to treat like royalty and serve in any way possible. So service is, if there's a secret sauce, it's commitment and service. I just would say that. And it's interesting because most people you talk to, they think, what's the note inventory? How much capital do you have? And they think about all these things that to me are backseat.
Interesting. That is
Really
a
good.
definitely a different way of looking at it, but it makes sense because from the people I've spoken to, a lot of them say that working with the borrower, especially in the non-performing space, tends to be the most profitable way, the most profitable exit as a note investor.
Yeah.
So, Martin, we were talking about how it's basically more difficult to be a kind of a toe in the water type of note investor, as you said, nowadays. How could you make that easier? Like, for example, I know that you wrote the book, Note Investing Made Easier. Would those things apply today, even though that you wrote that maybe, I think, a couple of years ago?
Yeah, so strengths and weaknesses. So much comes down to strengths and weaknesses. So what are your strengths? What do you bring to the table? What do you do, very well above and beyond, folks that are around you? And what are your weaknesses? And offsetting your weaknesses with your strengths, right? So you're finding other strategic partners that have weaknesses in areas that you have strengths in, and just doing a matchmaking service, like thinking about it from a dating perspective. What are you really good at? And you typically find a mate. You may be better with the money, and your partner's is not as good, and you kind of offset each other. So finding strategic partners that are in alignment with you from an integrity, from a mission standpoint, and finding ones where you can work together and not overlap as much. And there's synergistic effects that take place. And if you do that, then you can enter into larger deal flow opportunities as a result. So if you have, you come to the table, Kevin, with 100,000, Adam comes in with 50,000, I come in with 75,000, and we all take different portions of the due diligence process, and we all take down different portions of the note pool at the end, and all of a sudden, we're scaling up in theory before a purchase is made.
Yeah, it strikes me how similar it is to the multifamily investing space where I operate. To take down large apartment complexes, we must have a team, and we do exactly what you just suggested for playing a bigger game in the note space, and I love that. Another thing we do that I think is probably really similar is we really are big proponents of having a mentor, or someone who you can look up to and grow towards, and they can maybe help you. Could you talk to us a little bit about the importance of having a mentor as a note investor?
Sure. So my mentor is one of them is Marty Granoff of Granoff Enterprises, and he's been in the industry 30 years. And when I came into the space in 8 years ago, he was someone that I hooked up with. Now, oftentimes it's thought of like, what can a mentor provide to me? But I think, the thought is, what can I provide to that mentor? And in this case, I brought several deals to him that fit his buy box. He took them down. He did well as a result. And in exchange, I received, friendship and mentorship over the course of time. So that's kind of really the best kind of mentorship in my opinion, where it's organic, where there's, both parties are benefiting and getting what they're looking for. Other kinds of mentorship are paid for mentorship. Like, I have a very selective mentorship program, whereby I only work with a few individuals at a time. So it's not a mass production. But there's compensation. Someone has to pay me to go and spend that time with them. What's interesting, and this is probably applicable in multifamily and other areas of investing, is the people that are the most accessible and will give you the freest advice are probably the ones you don't want to be taking the advice from. So that's like what I learned from, and Facebook is a perfect example of that case in point. So you have to look at the people that are actually transacting. But even before that, this is to me, it all comes back to identity, because there's different mentors and different silos within the note space, and you really have to know what you're going after before you find the right mentor that is really, trailblazing, and that, whereby you can go approach that individual and see how you can make a connection.
Love
Makes
that.
sense.
I love that. I love that you were talking about it organically. Drawing a lot of parallels, just in kind of personal development, right? If you want to grow your network, figure out a way to add value to somebody, and it makes a lot of sense. I appreciate you breaking that down.
You know what's interesting, and I know, like, the term guru and canned training approaches, and they get a really bad rap. But what is also a silent killer for one's business is all the free advice that looks innocent, and really it comes from a place where everyone has an angle why they're doing the certain podcast or doing certain advertisements or placing comments on social media. They're trying to drive you into certain directions, and the less you know about yourself, and the more you're just going to kind of go with the flow, and you're going to say, well, I heard that land contracts are the way to go because you're not tied down, and so I heard that's the most profitable way, so let me go down this road. And then later someone else tells you first mortgage, institutional paper is more profitable, and you're kind of just going based on what you're hearing versus what you know to be true.
Yeah, and speaking of that, let's say somebody's listening to this now and they're interested in becoming a note investor. What are some things that they should look out for, whether it's avoiding gurus or avoiding that free advice that you were talking about? How should they navigate through that stuff?
So there's one thing that I do, and this is self-serving. I hold a 2-day fundamental class where I teach people the mechanics. But when we leave, and this is advice I just give to anyone, when they leave, I let them know my parting advice: don't buy a note within the first 30 days, because you're going to buy it based on emotion, and actually isolate yourself for the first 30 days, so you can take the material that we covered, and you can really digest it and start creative thinking, start mapping out your massive action plan and putting the pieces together, so you have some foundation about how this is all going to work before you kind of venture out. Because once you venture out into the flea market of note investing or any other kind of investing field, where everyone looks good and everyone sounds good and everything else, and you really just want to have a sense of what you're looking to accomplish. So that would be my advice, is really some isolation, some hardcore isolation, and whereby you're connecting with some material. And again, I only come from the junior lien perspective, so I'm not gonna be able to give you fundamentals of contract for deeds or fundamentals of senior lien mortgage purchases. So I just come from my niche. So figure out where you think you want to go and find some type of curriculum or training whereby you can take that training, go into hibernation where you're not further influenced, and really just start to digest the material.
Yeah, nice. Martin, I love how, as we're talking here, it's just occurring to me how organized you are. And, it really feels like your business approach is very organized and structured. And I'm just going to assume you've got systems and things in place like that. I was wondering if maybe you could talk to us a little bit about how you think about that, or even share, or like some systems you believe have been really good for you that you might share.
Yeah, absolutely. So I think everyone needs an operations manual. That should start day one. So where I would suggest individuals start is through journaling, and I journal. I just going to get my journal. I've been journaling for years. I plan all my days. I plan what my goals are, what my targets are, what I'm doing hourly. And so just journaling, so you can understand it just document, what's been going on. And every time, so how journaling's tied into operations manual is, for every new task that you do, you should be documenting that task needs to occur. And then at a later point, build a workflow for that task. And at some point, you're going to organize all those tasks into an operations manual by which it's a living document, and you're going to grow from it. So the whole idea is that, we already kind of talked about the mom and pop note investor is getting squeezed. It's getting harder to operate that way. So you have to come in committed to growing a business. And with growing a business, it entails employees, it entails 1099 help, and virtual assistants, strategic partners that you have strong alliances with, not just fly by night, punch them up when a deal comes through. But I'm talking about strategic partners where you're meeting monthly and you have goals, and then you have guidelines that by which everyone has to adhere to, and expectations and all that. So you need to have people around you that are driving you towards the end goal. And those people, in order for you to have a sense of what everyone needs to do, you need to have an operations manual. So I think that's critically important. It's interesting because, like, so much when I go through with mentorship with individuals, at least 50% of the mentorship is actually on helping someone launch a business, more than the technical day-to-day of note investing. So if you look at if you read Note Investing Fundamentals, I'm probably most proud of that book, and I really kind of delve into the three pillars of note investing. The first one being identity. So that's critically important. We kind of talked about knowing thyself, and the next one is community. So building the right community, but also, like as Jim Rome talks about, pruning the bushes, right? People don't cut people out of their lives nearly at the rate they need to. So there's we're all surrounded by negativity. We're all surrounded by people, mediocrity and all that. So you need to prune the bushes and build, a dense community of other like-minded individuals. But the third pillar is mechanics. And what you find with a lot of people in our space, in the note investing space, is they are fixated on mechanics. They want to know every nuance in every state. Where do you need licensing? Where can I self-service? Where, what do I need to do for RESPA? What do I need to do? And they focus on mechanics. And what happens is, if you go and you focus on the mechanics only, then you're not balanced as a business owner. And you will find and attract other people fixated on mechanics. And if you ever want to have a snooze fest, or if you ever want a business that will go nowhere, just hang out with a bunch of people that are just fixated. You guys are technical guys, so I'm like offending you. I'm sorry.
No,
But
not at all.
fixated on just the mechanics of things, and whereby there's no there's no exploration of community and sourcing and deal flow, which is the lifeblood of a note business.
Yeah, it's great. And I mean, so much of what you're talking about applies to many, many different businesses, and just being successful at running a business in general. You just happen to be focused on the note business. But as tech guys, I mean, Kevin and I see what you're talking about in our day job. And what you mentioned there, uh, even the most technical of geeks do, right? Like serious coders will get together and they'll have hackathons and they'll share ideas and things like that. So yeah, I mean, it's really, really good stuff.
And that's great. I mean, we have a team of asset managers. We have an asset manager that just works with our reperforming loans, and we have a compliance manager. We have a collateral manager, so they can go and geek out and talk, mechanics all day long, because I want them to grow and flourish in their roles, and and be better at their position. However, for myself, for you guys that are growing a business, you need to be around other people doing the same thing.
I love that. Now, I know we were just kind of harping on, if you want to be bored, listen to people talk about mechanics, but you did talk about junior liens. And I was curious from a COVID's perspective. I know that for first position residential, there was eviction and foreclosure moratoriums. How was the second or junior position affected by COVID-19?
They fall under the same moratorium, where where evictions and so many of those moratoriums have started to expire, and things really are open back up in a major way. I would just say that, I know there's been a lot of forbearance talk, and there's been a lot of forbearance promotion. Many of those loans the loans that fall under the CARES Act are primarily government backed mortgages, so Fannie and Freddie backed, and so the mortgages we buy on the secondary market aren't applicable. However, aren't applicable to the CARES Act. However, we want to keep it, we want to be in keeping with what the expectations are in the marketplace when we're pursuing foreclosure. However, with that said, the one thing that we pride ourselves in is, if you ask any of our asset managers what the number one attribute is for their job description, it's compassion. So I harp on that. I place intelligence at like number 8 on the list, and compassion and being genuine and helpful, that's like ranking way up top. So, if we're talking to someone in COVID, and who's been affected by COVID, and they're going through some hardship, I mean, we want to verify what's going on with their situation, but we also want to see if we can work out some resolution by which we can, still operate our business and keep the doors open. We've been very surprised at our collectability percentage during COVID. We maintain on our reperforming loans a 99. We look to strive for 90% and above for collectability percentages with our performing paper that we hold. We've been at 93 all year during COVID. And we thought when COVID first hit that we would be dropping to like 75% collected. So what that means is, 3 out of the 4 borrowers that are paying, continue to pay, 1 stops paying, but we've been maintaining 93%, which is above industry standards. And what I suspect, and I'm not a psychologist by any means, but what I believe in my heart of hearts is that people have gained a stronger appreciation for their home during COVID. So they may not buy the new pair of shoes or go out, partying Friday night, but they know that they're working at a home now. They're at home more than they've ever been at home. Their kids are at home, homeschooling. So there's more of an appreciation to say, we're not losing this home.
Yeah, that's great. And Martin, I was wondering if you could talk to us a little bit about how junior liens are different. I mean, I know they're different than one who invests in the first position liens, but maybe you can talk to us, for those who aren't note investors but interested, how it's different.
Yeah, so this question I don't care for, because I can't distinguish between the junior and senior without selling why someone should be a junior lien player. So there's just no way to do it. I will say that on average, look at the fair market values of the senior lien inventory versus the junior lien inventory. So you will find a significantly higher fair market value on average for junior lien purchases. And so that's very important to us because our mission is to keep homeowners in their homes. And we actually go to the auction block less than 1% of the time with our portfolio, which is insanely low in the
Wow.
industry. So we vet these loans with the understanding that we only are looking for inventory whereby we feel based on due diligence on the borrower and property that we can keep that homeowner in their home. And so that's mandatory for us. So property values ties into that high workout percentage. When if you meet with some folks, that are more on the senior lien side, you will find that they typically take back the property a much higher percentage of the time.
Do you know, can you talk to us about why that is?
I would suspect that the lower the fair market value, the higher the likelihood you're going to take back the home. So whereas, someone, if you have a lot of senior lien loans, you might look at properties, 60K, 80K, something like that. You might find a borrower that can say, hey, well, I'm just going to, I'll just go rent a house for $400 a month, something like that. Or they're just more prone to exit. I don't really know. I'd be speculating. I just know that with the fair market values we look at, and then the other due diligence parameters that we key in on, we're taking back the property 1% of the time. But when I talk to folks in the senior space, that buy a lot of seniors, I hear, 30% of the time they're taking back the properties. And I think it deals with the fair market value, if I would have to guess.
Okay. And we're talking about fair market value, just so that our listeners understand. Are you talking about the fair market value of the note or the fair market value of the property?
Fair market value of the property.
Okay. Awesome.
Yeah.
So
So
from a sorry, go ahead.
I'm going to make a distinction. So that's a good point. So when we buy junior liens, we in almost every case have full equity coverage of our position. So if we have a property, I think in our income fund, Bequest Funds, we have, I think our average fair market values of right around 300,000. So if you take a property at 300,000 fair market value, that's the property valuation, and the seniors at 100,000, then there's 200,000 of equity coverage backing, our loan position. So if we have a $50,000 junior lien, then we have what's called full equity coverage.
I see. Okay. Now, just out of curiosity, when we talk about junior liens, is that specifically second liens? I've heard there's third and fourth liens. And how does somebody get into a second position mortgage?
Yeah. So it's so much, it's not so much they got into it. So I'll buy second, third, fourth. It doesn't matter to me. What matters to me is equity coverage and performance of the senior liens that are in front of me. So as a rule of thumb in our industry, if they're paying the senior lien, the lien that's in front of you, they're probably paying their property taxes. If they're paying their property taxes, they're probably paying their homeowner's insurance. If they're paying everyone around you but you, and there's equity coverage backing your loan, they're probably going to pay you. That's kind of like a rule of thumb for the industry. However, on the senior lien side, if they're not paying you, then they're probably not paying their property taxes. If they're not paying their property taxes, they're probably not paying their homeowner's insurance. And then any kind of encumbrances with the town or county or what have you, municipal liens and whatnot. So there is a more of a punching bag of expenses one has to deal with when entering the senior lien space. So it's, as a junior lien, we kind of sit back and watch the senior lien holders absorb the expenses.
Um,
See, I told
So,
you I'm going to start selling junior lien. I don't
no,
want to
no
do that,
problem.
Kevin. I don't want to, Adam, I don't want to do it.
Well, okay. When we're talking about seconds, when typically I think of somebody has like a HELOC or something where they mortgage their house, they have a ton of equity. And this is my ignorance to the second space, but can you have like a second position commercial note of some kind? And is that something
Absolutely.
that
So,
somebody could buy?
a large percentage of business sales in the country that involve, is some real estate or not, come with some sort of seller financing. So, and usually the seller financing can be in the second lien position behind some type of institutional debt for that business. So it's very common to have commercial paper in the junior lien.
Didn't know that. Learned something new today.
Yeah.
Yeah, interesting. That was kind of a question I had as well. Being someone who invests in multifamily, large multifamily above 5 units, which are commercial properties, I was curious if there are note investors who focus on those types of notes.
Yeah, I mean, it all depends on what your exit strategy is. So you're going to buy a note, you're either exiting through the property or through the bar, right? Like
Mm-hmm.
one of those is happening. You exit through the bar is going to reinstate, they're going to pay you whatever's owed and catch the loan up. They're going to pay you off. They're going to they're going to do you're going to do a loan modification and they're going to start making payments to you. Or you exit through the property and either through a deed in lieu or you take it back through at the auction. So you can do a deed in lieu from a junior lien perspective too. So
Didn't know that.
if your focus is on taking back the property to do some type of reposition play, then you can do that whether you're on the junior lien or senior lien side.
Awesome. When you talked about these relationships that people should be forging, what does that look like? Is it other investors? Is it lawyers? The way I think about it is who would I need on my team, but I'd love to get your perspective on that.
Yeah, so I kind of think about it more of not so much my team, but looking to first find people with common objectives and getting to know them whereby whereby there's some objectives, right? Like Kevin, let's say you're starting and I'm starting and we both know that we want senior lien institutional originated paper. So these are loans, they were originated at a bank at one point and they went through Fannie and Freddie underwriting guidelines. So this is what we like. And we like fair market values of 100K to 120K. We like these 20 states in the country. And we're both in sync with all this. However, I'm not technical. I'm great. I can talk to anyone. I can raise capital. I can, X, Y, Z that way. But you're very technical. And so you want to be more heavy leaning onto the due diligence side, making sure that you're vetting property, you're vetting you're pulling title reports, you're pulling credit reports, skip tracing, you're doing all that and all the analysis behind it. And so and then I have 100,000, you have 100,000. So we figure out a way to go and join forces and go out to the marketplace and look for a $200,000 pool of mortgage notes. And so that just kind of now we land a deal or two. And lo and behold, this guy Adam shows up, right? Adam is not very technical and he doesn't like people, right? So, but Adam happens to have $1 million in the bank. So we really like Adam, right? And so we figure out a way to plug Adam in. And before you know it, we go to the market looking for a $1.2 million opportunity. And so we start moving upstream, right?
I like it.
And so However, what we're talking about is just high level, and it can't be loosey goosey. It has to be where we really try to cement something, some understanding, some expectations, and we cannot. We're not just going to come meet up once a week and then talk about how FCI sucks and Landhome's good servicer, and talk about all the technical going ons of the day. And so we're going to get on and we're going to say, hey, you know what, Kevin, you're responsible for sourcing XYZ. I'm responsible for sourcing, ABC. So where, there's metrics behind, what we each need to bring to the table. And if I'm not meeting the metrics, you need to move on from me. So it just polygamy, right? Because you can have multiple strategic partners, so that's awesome. And however, you have to watch out because how you operate, because if you go into certain opportunities, you don't want to bid through two parties, through two groups. So you just want to make sure the integrity thing is is there, and you're being upfront with the people that you're working around. And by the way, the more that you forge these groups and grow them organically and kick ass, the more that you will start to be recognized in the space as a player. And then the magnetic thing occurs. Like today, I don't source deals. I mean, they're coming because we close. I mean, we always close, and we do what we say we're going to do. So by virtue of that, in my reputation, deals are just coming. We closed 4 trades this month. It was a very big month, and so that's where you want to be. But you got to go first things first, right? You got to go on the dating scene.
That's great. And it feels like we've covered so much in this episode, and it really does feel like a great note investing fundamentals episode, as it were. Martin, we wouldn't be the tech guys who invest if we didn't ask you a tech question. So I'd like to ask you, what's a piece of technology that you feel like makes your life better?
My 10BII calculator is my love and life.
Nice.
And I actually
That's great.
So the first person I mentored, Shawn Muneio, he's a tech guy. He came from the tech world, and he's also a finance guy, mathematician. So he's extremely technical. And I am extremely not technical. So the calculators is that's as far as I go.
That's great.
That's all you need, apparently.
Yeah. I'm good at calculator and Excel spreadsheet. That's note investing right there.
Awesome. Well, Martin, if people want to learn more about you, where can they find you?
Sure. So we have an income fund for accredited investors called Bequest Funds, and you can go to bqfunds.com. Or if you have some interest in learning the fundamentals of note investing, you can go to noteinvestingmadeeasier.com.
Awesome. Well, Martin, thank you so much for adding tremendous value. We kind of jumped around a lot, but I love the conversation. I learned a bunch, and I'm sure Adam did as well. Thank you again for being such an awesome guest on the Tech Guys Who Invest podcast.
Oh, thanks for having me, guys. I had a lot of fun.